Good evening, good evening, good evening. It is Wednesday, April 5th, 2023, and this year is going by faster than I expected it to go by. It feels like it was February 2 weeks ago. So, without further ado, let's just jump into this video. In this video, we're going to be talking about creating a trading buffer. Now, it sounds like a strange word. It sounds like it brings up many questions. What is a buffer? Why would anybody want to use a buffer? How is a buffer going to help me trade? Well, we're going to go over that. So let's start off from the beginning. What is a trading buffer and why is it helpful? So, a trading buffer serves your trading account the way a jacket serves you in the cold weather. If you just go outside, you can go outside with a t-shirt on, with no shirt on. I'm pretty sure you'll be fine if you're not out there for a long time. But if you put a jacket on, that serves as a little buffer and a little layer of protection against you and the wind or whatever the weather conditions are. So how is that going to be applied to trading? How is a trading buffer similar to wearing a jacket? Well, if you have a $25,000 margin account that allows you to day trade, keep in mind that in order to day trade, you need at least $25,000 in a margin account, unless you have a cash account. You can day trade with less than $25,000 in your account. However, it has to be a cash account, and the amount that you make won't be settled until the next day, in comparison to a margin account where it will be instantly settled. Now, if that makes no sense to you at all, I'm just gonna go into this very quickly. I'll probably make another video about it in the future, but it basically means that if you're trading an account, a cash account that allows you to day trade, that's $10,000, and you're trading Tesla, and the cost to place an option trade with Tesla is $1,000, you can only make 10 trades that day, which might limit your ability to trade well and your ability to maximize your profits, because you might get in and out of very small trades with small profits or small losses or break-evens. The good thing about a margin account is that you have 25,000. Well, I'm not advocating whether to get it cash or a margin, but I'm just telling you the difference. The margin account, if you have $25,000 in it, you will be approved to day trade, so your account won't be flagged as a day trader, and you will have more cash to trade with. A lot of brokerages, they 2x that amount, so you'll have 50,000 to trade with, which is basically like borrowing it in a way. You're not necessarily going to lose it if you have correct risk management, but it settles instantly. So the moment you close out of a trade, it will settle into your account and you can continue to trade with it. So let's go back to the trading buffer. Now, if you have $25,000 in your account, you want to create a little buffer. Maybe have 26 or 27,000 in there before you start, in case the value make an extra 1,000 or 2,000, and then you can start to trade a little bit larger and take more risk, because the only thing that you're going to lose at that moment is time, but you will also learn a lesson. So when you're starting to trade, when you make that initial deposit, you want to make sure that you're trading reasonable sizes. You want to make sure you're trading reasonable sizes all the time. But when people make more, they tend to risk a little bit more. So if you have $25,000 and you're trading one contract, you might grow that up to 30, 35, 40, 50, and then start trading two, and then 65, 75, and then 3, and then so on and so forth. It's a gradual increase of the amounts of contracts you purchase, or the amount of shares that you purchase, or the amount of lots, if you're trading Forex, that you purchase. So you want this buffer just to keep your initial investment safe. There's nothing worse than having a margin call or having or losing your money. So create this little buffer and then keep your initial investment in there, but have that buffer just for safekeeping. And like I said, the only thing that you're going to be losing is time. Now, I say that lightly. Time is a very valuable thing. It's an extremely valuable thing. It's all we have. But creating that buffer will allow you to trade with something other than your initial investment. You can learn that way. Well, I would suggest you learn on a paper account first, but you can learn a lot that way, and it also brings you a deeper sense of security, a deeper sense of financial security. So start trading, make your initial investment, make sure you know what you're doing beforehand, create that buffer, preferably of the amount that you put in, and then withdraw your initial investment and then trade with that. But you have to know what you're doing, and that's why we're here, to teach you that, to teach you how to trade, to teach you how to invest your money the right way so that you can be profitable and you don't have to be one of these people that have margin calls, that lose their money in the stock market because they have no idea what they're doing or what they're investing in or how they're trading. This is very, very this is a risk. However, it's a very calculated risk. So, is it essential to have one? Is it essential? No, it's not. It's not essential at all, but it is suggested that you have one. And how much should you initially deposit day trade with? However much you're comfortable. I would suggest above $25,000. The reason why is because you can have a margin account. You can still day trade with less than 25 with a cash account. However, you won't have that. You won't have the ability to place as many trades, because if you are trading with a account size over $25,000, that's a margin, you have 2 times that amount depending on your broker to trade with. So if Tesla cost $1,000 to trade, you can trade Tesla probably about 50 times with a margin account, with an initial deposit of $25,000 in it. However, if you have a $10,000 cash account, then you can only trade that 10 times that day. And you never know how many times you're going to close in and out of a trade, because there might be break-even trades, small profits, or small losses. And with a margin account, the 25, the cash that you make settles instantly, and with a cash account, it settles the next day. So, with that being said, I would recommend over $25,000, but if you know what you're doing, and if you know how to trade, and you're confident in your abilities because you've practiced, then you can make an initial deposit of maybe $1,000 or $2,000 and grow that from there. Maybe even less, depending on what you trade. So, with that being said, creating a trading buffer can and is a safe thing to do. It can improve. It can bring you more inner peace, because you know that you're not risking your own money the moment you create that buffer. You're risking your time, but you're not your money. There's some type of exchange going on there, and all the best. I mean, we're all here for the same reasons: financial abundance, financial independence. We all want to be financially secure, well off, to able to live the life that we truly want to live. So, if you have any questions, go over to our website, reach out. Be glad to help you with anything.